Hey, welcome to another edition of Coffee with Kirk. Appreciate you taking time out of your day to check some of this out. So today we're going to hit just a couple different topics. First, I'm just going to give you guys an update on what's going on with the merger of Picket Fence Financial to Bastion Fiduciary. Then we'll talk a little bit about the jobs number. I got some questions on that. Really good jobs number that came out. We'll talk about that. And then we'll sort of get into how have things progressed since the Fed cut rates a month ago, and we'll look at that. How does the jobs affect into that? And then finally, had some questions about gold. So gold obviously has just been going gangbusters this year. Is it still worth adding to gold? Is it, should we still invest in it? And then I'm going to finish up with just something that's been kind of off the radar for people, but of course it's another little government requirement that's coming in place for if you have any kind of business ownership, and we'll talk a little bit about that. So let's do what we always do and jump into some slides so we can chat a little bit here. But starting it off, the jobs number from yesterday was really good. It was way better than what they're expecting, pretty much twice what the markets were expecting. So they were expecting about 125,000 jobs to be created, and they got 254,000. So that's obviously good, but we talked about it before. Just a month ago, Bureau of Labor Statistics does a one-time kind of finalized number for jobs, and they subtracted out, I think it was 880,000 jobs that were created in 2023 that weren't. So they were off by over 800,000. So this one's hard to digest a little bit. This is what they would call a 4 sigma beat. So if they're expecting 125 and you got all the way out to 225, I mean, if you remember your statistics class from college or high school, one standard deviation it encompasses 95% of all the possible outcomes, and then 2 standard deviations takes it even a little bit further, to be 97.5. So when you get to 4 sigma, you're talking really something that completely unexpected. So doesn't mean that didn't happen. And the other thing too is a household survey, which we have talked about the difference between the establishment survey that gets all the press, and then the household survey, which doesn't get much press, but it's also, it's where they're calling households to see if they're employed. That one actually went up quite a bit to 430,000 jobs. So something definitely was happening there. I always kind of think households a little more accurate because it doesn't probably get the manipulation, because it's not something that they discuss a lot on CNBC and Fox Business News and all of that. It's usually the establishment survey. And we've shown you a slide where over the past couple of years, there's been a huge variance between household and establishment survey, which in the past didn't really exist. So this one's been kind of an odd one. Unemployment rate dipped down 0.1%. So that was good. That also kind of invalidated the SOM rule, which is what I talked about a month or so ago, that basically preceded all recessions. So maybe that's not happening. Now some negatives. I couldn't find a chart for it, but temporary job holders lost a lot of jobs. And as I've mentioned in the past, that's one area that tends to go first in employment. Obviously, you don't want to lay off W-2 employees, your own employees. But if you have somebody from a temp agency, it's pretty easy to let them go. So a lot of temp jobs have gone. And then the number of people holding multiple jobs right now continues to climb. I just don't think that's all that good of a thing. The other big thing is and this is why it could actually be accurate. A lot of government work, a A lot of government workers were added. Actually, if you look at the establishment survey and the household survey for private workers, it was actually down to barely up. Household was barely up, and private workers for the establishment survey were down. Whereas with government workers, holy crap, adding at least 700,000 or 800,000 workers in a month for both surveys. So that's a lot of, and I'm trying to think, is there some temporary government program going on? What's happening? I don't know what would cause that, but that's a massive number. We do not want that number going up like that every month. So, I mean, unless you're a huge government fan, but typically I'm not. Seasonal adjustments were probably another area that was kind of off. Now, what does that mean, seasonal adjustments? Well, sometimes the Bureau of Labor Statistics will basically adjust the numbers to try to smooth things out and ignore what the raw data is showing. So, clearly, like Christmas time, they're going to add a lot of people just to work in stores. So sometimes they'll adjust that so it doesn't look too out of whack compared to the summertime or the springtime. So this one, when you don't seasonally adjust, really from September 2023 to September 24, there's not that many more jobs that have been added, less than 100,000. So, so some discrepancies on that. So, this was a tweet I saw shortly after those numbers were released. And this is a guy I follow on Twitter, obviously, but he's kind of he's not really an economist, but talks a lot about economic issues. And this is kind of summed it up. It's either, U.S. economy is really doing well, and then all of these other things I've been seeing showing kind of slowdown just are wrong, and we're heading way out of it. And that is a very valid option. The economy is still weakening, but it's still fighting and hanging on, or we are 4 weeks before an election, and the data was obviously tweaked a little bit. And you hate to think like that, but it is a reality. And it's not that if a Republican was in office, they wouldn't probably be doing the same thing. That's the whole point. They manipulate the data to try to make them, who's ever got the power tries to make themselves look better. And it's kind of interesting when that 880,000 job loss, where they wiped out a whole year's worth of jobs, when that came out, there was no talk of it. Even people that were asked about it in the Biden administration just kind of act like they didn't know what it was. And yesterday, you can be sure that they were hyping this number. So we'll see. So essentially, I've showed you all these slides to say I'm going to wait and see on this one. I don't really know if that's legit. If there was some sort of government program, like if they were hiring for, pollsters or, people working in voting booths and things, maybe that's why the government jobs went up for the month. I don't know. And then they didn't do any seasonal adjustment on it. They just threw the raw data to it. But I don't know. Not sure. Just something to watch. And the thing is, so all of this stuff, so once the jobs numbers came out, people started, the market started pricing in fewer Fed rate cuts. And let me jump to those slides real quick. So as soon as it came out yesterday, this chart's a little bit of a busy chart, but it's kind of showing what the market expects for 2020. The top part of it is the green and red lines are what they expect in 2024. So the remainder of this year, and then the 2025 rate cuts. And you could see they were expecting, it's been going down all year, but then it kind of collapsed when this jobs number came out. So they said they don't expect the Fed to really cut much. So they're expecting maybe another 50 basis points in 2024, and then maybe a little less than 1% in 2025. But both of those dropped precipitously. And if you wanted to kind of get a feel for what they did, the bottom graph, the line in blue, is essentially from now until the end of 2025. So they were expecting, about 1.7% further decline in the Fed's fund rate, and that's dropped to 1.5. So they basically, so this number, if in fact it's legit and the markets are expecting less stimulus, which usually if the market expects less stimulus, the stock markets go down. That didn't happen yesterday, but that's typically what ends up happening because the stock markets, they love that liquidity. And then really, since the Fed has cut rates in September, things have gone, I guess, not according to plan, what you would expect. So the US dollar relative to the euro has actually strengthened since the Fed cut rates, and the same can be said for the US dollar to the Japanese yen. That shouldn't have actually happened, because when the Fed cuts rates and the other central banks around the world kind of maintain where they're at, well, then it just means that our rates are coming down, which makes the dollar a little less attractive. So the dollar typically loses value relative to everything else. And if you look at the actual first reaction, here looking at, September 9th, you did see an initial reaction down for the US dollar compared to the euro, and shortly for the Japanese yen. But since then, it's done just the opposite. The dollar has been getting stronger. So that's a kind of an interesting situation. That could be that usually when there's uncertainty, money will run to the US dollar. So maybe they're starting to see a slowing economy elsewhere. That could be part of it. It's hard to tell because it's something that shouldn't have happened because of the Fed lowering rates. The other weird thing that kind of took place is, well, this one's a little more believable. When you cut rates, the dollar should weaken, right? I just said that. So usually when the Fed's cutting rates, the dollar weakens. When the dollar weakens, that's not good for you as a consumer, because the dollar you have in your pocket now is a little bit weaker. It's not going to buy as much goods and services. So commodities do tend to go up. All things priced in the dollar should go up. And that's what we've seen with commodities since then. This is the commodity ETF that we'll use time to time. And it's up about 8% since the Fed has cut rates. And, so that would be inflationary. That would be what you'd expect if the dollar's losing value. But we're seeing the dollar's actually gaining value and the commodities are going up. Same for oil. So going to the big one, the big commodity that we all focus on. If you get in here, this is the 1 month. But essentially since the Fed cut, we've gone from about $67 per barrel. We're back up to $74 a barrel. So oil's kind of held. And oil stocks also, since the Fed cut, have gone up about 7%. So, you could expect commodities to go up if the dollar is weakening, but the dollar is actually getting stronger. So, is this actually inflationary, or are we seeing an inflationary trend? If the dollar is going up, commodities should be under a little bit of pressure, but they're not. So interesting little thing there. And then the other thing that's kind of thrown people off with the Fed cutting rates, everyone thought, well, mortgages will get cheaper. Lending on cars, autos, everything that you're going to borrow for, including credit cards, should go down. But since the Fed cut in September, you can kind of see that bond yields have spiked back up. So we were down close to 3.6% when the Fed cut initially, and now we're back up to 3.95. This is the 10-year Treasury. And the 10-year Treasury is what basically most loans are tied to. Definitely mortgage rates are tied to that. So they thought, oh, great, the Fed's finally cutting, and now we'll start to see that rates will go down, home prices will get better, they'll go up from here, that kind of thing. But we've seen exactly the opposite of what the markets were expecting here. So all of that's a pretty interesting thing and to continue to watch. So the bond yields and commodities going up like this says inflation. So maybe we have shift from maybe where I thought we were heading to sort of a deflation, slowing GDP growth. Maybe it's going the other way. So maybe the demand for commodities and the increase in yields are saying we're expecting more inflationary or more growth in the economy. And that could be with the jobs numbers showing that, hey, maybe if jobs continue to go up at that kind of rate, over 250,000 a month, well, then the economy is going to start booming. So maybe that's what everything's saying. We'll just have to wait and see. Again, the job numbers, were they influenced at all with it being the last report before the election? I don't know. So we'll see what transpires from here. But the one thing I get a lot of questions on is gold. And especially, we've got gold in portfolios. People say, should we add more? Should I buy more? Should I buy physical bullion? And so let's look back and see, what is gold usually telling us when, it has a really increase in price. It's such a short period. And this is going back to January 2007. You can kind of see for that whole year, gold was on fire. It really took off from about 600 an ounce to 960 an ounce. And then if you look at it, basically up until the recession started in 2008, gold went up about 50%. So we saw a 50% increase in gold before the 2008 recession. And it's not necessarily just something that happened in 07, 08. It also happened in 1972, which led to, the 1973, 74 recession where, the market dropped about 50%. Oil prices went up quite a bit. I'm sure a lot of you remember that very well. So we saw kind of the same pattern back then, that from November 72 for the next 12 months, gold once again went up 50%. And then if you look at it kind of today, kind of a similar chart. We'll talk a little bit more about it, but we've certainly seen a big move up. So, what's that kind of trying to tell us here? Well, this is a chart of the gross domestic product or economic growth dating all the way back to, late 50s. And you can kind of see this blue line, periods where it goes up considerably and periods where it's coming down. Well, then what we want to do is kind of put down the price of gold relative to all of this. Now, if you notice at the far left, gold had a straight line where it was at $35 an ounce. And they basically kept it there all the way from when FDR took office. FDR basically doubled the price of gold overnight, and then it stayed there until Nixon took us off the gold standard in 71. And then we can see from 71 on what the price of gold did in the black line there. But as you look at the price of gold and you look at that economic activity, essentially what you're going to start to see is the periods where the price of gold went up substantially correlate almost perfectly with periods where economic activity declined considerably. So going back to that 1972 period and then the 2007 to 2008 period, that's exactly what you saw. It was gold doing very well while economic growth slowed. Now, if we take the same chart and what we do is we invert the price of gold. So we're just going to flip gold around. So as gold is going down, that actually is where the price of gold was going up on the previous chart. This is just to give us a little bit more of a visual representation of the periods when economic activity, the blue line, is going down precipitously. You could see the gold price was going up at the same period. So basically the same chart as before, but just inverting the price of gold. And in periods where economic activity was going up, you see a stagnation or even a decline in the price of gold. So there's definitely, gold is, I've always said, it's a insurance policy against chaos, and that's its first thing. Now everyone says, oh, it's also an inflation hedge, and ultimately it is an inflation hedge. But if you line up the price of gold with the inflation rate, it's not necessarily as strongly correlated as this chart. From endpoint to endpoint, if you're looking at 10, 15, 20 years, gold is an inflation hedge. You could buy a car with the same number of ounces of gold today as you could back in 1970. But it didn't mean that gold was tracking inflation perfectly. So the price of gold, if we look here from basically after the 2008 debacle, up until really recently, up until post-COVID, the price of gold was going down, but we still had inflation in that period. So it's one of those, it didn't really tie. It's not like if inflation's 3%, gold goes up 3%. So it's not a perfect correlation, but ultimately your purchasing power remains with gold. That's sort of the key point. But really what gold is, it's an insurance policy against chaos, and it does a great job of alerting us to periods where we expect lower economic activity. That's what it does. So digging in just a little bit more in this inverted chart here, when we had the recession of 1990 and the recession of 01 to 02, the price of gold was actually pretty stable. And when you look at what happened in those recessions, they were pretty mild recessions for the most part. The 1990 recession, I don't even think it was like a 2% decline in GDP. And even though the tech bubble bursting, the 2000 to 2002, the market lost 50%. So you'd think it'd be a pretty severe recession, but it wasn't. I think economic activity was only down 2.3%. So that was interesting. The price of gold, for the most part, it went up a little bit, maybe indicating some weakness in economic activity incoming, but it wasn't something that was huge because it wasn't a big drawdown of economic activity. So again, just to give you kind of a view of the previous gold movements in 72 and 08, we saw basically a 50% increase in the price of gold before the recession. So far today, what's gold telling us? Well, it's up about 34%. So maybe it's going to continue to go up to hit that 50% thing, and then we'd see a pretty bad recession or something like that if history were to repeat perfectly. Or it's just saying maybe we're seeing some economic slowdown, but not quite like what we saw in 1973 and 2008. So we'll see. So is gold still a good investment? Yeah, I think it is. This is just a chart kind of showing you a technical that gold is kind of broken through a long-term trend here. And usually when you see something like that happen, it continues to go up quite a bit. Now, is it good this very second? I've got a client like, I want to put some more in gold. And it's been on such fire lately that I would think we're going to see some sort of short-term pullback, maybe a 10% pullback in the price of gold. We're kind of due for it. If we did get a 10% pullback, I'd probably be a lot more bullish. But there is certainly a good case to be made that there's some long-term potential with the price of gold. And when you look at gold's, cousins or brothers, whatever you want to say, silver and gold miners. They've also been doing very well this year. So if we are truly in a period where precious metals are going to do well, then you're probably going to even see better performance from silver and the gold miners. The gold and silver miners are actually kind of leverage play on gold and silver. So usually you're going to see them move much more rapidly up or down depending on the price, because you're really, when you buy a miner, you're also kind of buying the gold and silver that's in the ground still. So there's a lot of potential there. Now, there's always risk with miners because they're companies. You could have the company poorly run. You could have a lot of these mines are in countries with less stable government. So there is additional risk with miners that isn't tied to the price of gold or silver. But if you've been on these for a while, I did a kind of a full session on miners about a year, maybe a year and a half ago. And the miners, they're not the wildcat companies that they used to be. A lot of them are very well managed and have very good cash flow, and they have really worked down their debt. So I think I might just do another breakdown on the miners here. So this chart is just showing you year to date what they've done. So gold's up about 28.7%, silver's up almost 36%, and then the miners are up 27%. Now, if you go back a little bit further, let's go back to 5 years. So this is the same chart, only over a 5-year period. You can kind of see gold and silver have sort of tracked each other for the most part. Silver doing a little bit better, but the performance of the miners has been drastically down relative to gold and silver. So you could look at that and say, the miners have a little bit of catching up to do. And that could be true. So we really saw when the COVID or 2022, and when stocks in general did poorly, that's sort of when we had a huge break between gold miners and the actual precious metals themselves. So, I'm kind of looking at that as a place to go. Okay, so this is a little thing here that hasn't gotten much press, but it's one of those that in typical, I guess I would say, government fashion, you could be facing some fines, you could be facing some penalties, interest, all that good stuff. So the federal government passed the Corporate Transparency Act recently. So what this is going to do is it's going to require all owners, principals, and other control persons that essentially any kind of corporation, whether it's a limited liability corporation, an S corporation, or C corporation, along with limited partnerships, they're going to have to file a form basically letting the government know who owns these companies. So the federal government's worried that there's basically cheats going on, that there's a lot of corporations being set up that are just used for tax evasion. So they're, of course, rather than maybe asking the states to provide some information, because you do register every corporation with the state, so you have to file to be valid in the state that you're filing in. So you've already doing something to make sure that your corporation is active and within some legal guidelines of the state, at least. So the feds now are basically going to try to make you duplicate this effort at the federal level. And this was part of the National Defense Authorization Act. So it's not even something that really has anything to do with corporate transparency, but it's just one of those they threw a few pages in that 3,000 page bill, and now this is something we have to do. And the thing is, you may be affected by this, and like, I don't own a business. Well, maybe you have a rental property and you put it inside an LLC, or maybe part of your estate plan eventually put some of the assets that you've got into an LLC or some other asset protection structure, like a limited partnership. So this thing could hit a lot of people that aren't expecting to be hit with this. So if you do have rental properties in LLCs, if you have anything like that, this is going to affect you. Obviously, it's going to affect you if you own a business. So if you have a business and you're incorporated in any way, LLC, limited partnership, S or C Corp, this does affect you. If you are just a sole proprietorship, this does not affect you. You do not have to file because when you do your tax return, you'll do a Schedule C, which is on your personal return. So they're going to know that you as an individual have a corporation and it's on your tax return. So they're not worried that you're trying to scam the government. And the financial center that's requiring this report is projecting that there's probably 32 million existing entities that may face these obligations. And to put this in perspective, to date, only 1% of these have actually filed. I have 3 corporations that are going to need to be filed, and I haven't done it myself. And we have until January 1st of 2025. So I'm recommending, I'm going to try to do mine next week if I can, because as we get closer to this deadline, the FinCEN website is probably going to get a lot of traffic. And if you ever worked with government organizations, when a lot of people try to use it at the same time, it wasn't built for heavy traffic. So there could be issues with that. So if you had a existing entity before January 1st, 2024, you have to file by January 1st, 2025. If you file in 2024, so if you started a business in 2024, you basically only had 90 days from formation to file. So if you open up a business in February, technically, if you haven't filed this, you are in default because you should have filed by June of 2024. Now, if you going forward after 2025, when this thing is fully in effect, if you start a new entity, you've got 30 days to report this to the government. So again, there's going to be some severe penalties for noncompliance, of course. And then, there's been so little talk about this that I think it's going to be an issue for people. And a little note here, the bottom one's just saying, basically, we kind of talked about this. If you have a sole proprietorship or general partnership, this won't necessarily affect you. But a couple who purchases a weekend home but uses an LLC to insulate themselves from liability for anything occurring on the property will be subject to these rules. So again, I won't go too much into this, but this is definitely something you should probably talk to a CPA or a business attorney to handle. And a lot of CPAs aren't even handling this because it is sort of out of the realm of taxes. As I mentioned, and I'll talk about this in a little bit, I sold my tax portion of the business. I was not doing these forms, but the CPA firm that bought my tax business is doing these forms. So if you are interested, they can do that for you. They are doing this. But the big thing here, is just the deadline is coming, and it's coming up here fast. And in some cases, if you have a pretty complicated situation, it might take you a while to compile all the data needed to fill out this form. The other thing that's going to be just a total pain with this is if you have any changes to your corporation, you've got 30 days to basically update the government on that. So it could be something as simple as, a name change. So if you get married and you take your spouse's last name, you'd have 30 days to update it. Obviously, a change of address or any other unique identifying number, you'd have to update that. If you switch corporate ownerships, if you install a new trustee, anything like that, a new principal to the business, all of this is going to have to be updated. So I just wanted to get this out here so that people know it's out there, and you need to put it on your radar because the deadline's coming up fast. If you have any questions on it, please reach out to me. I know a lot of you, this probably doesn't apply to you, but this is definitely something that everybody should be at least thinking about if you have any kind of corporate structure whatsoever. And I do have a lot of clients that do. Okay, and of course, we finish with the usual lawyer say hello. If you need the full disclaimer, please stop the video and check that out. So last thing I just want to talk about is I've been mentioning a lot of changes in my business structure. So the first thing is I finally got rid of the tax business. It was just getting to be too much of a burden. I'm getting to my mid-50s here and kind of tired of working until 9 p.m. Just, and it's getting harder to deal with the state and IRS. And I've had enough, honestly. The other thing, it did affect the service I was providing to financial planning clients, only because I've had difficulty keeping some staff. And not that I'm any kind of slave driver or anything like that. Just, some people, one person, she was a phenomenal tax office manager. I didn't have to think about the tax office for the most part. But then, she basically got married. Between the two of them, they had plenty of money. So she retired. She still would do taxes for me, but didn't want to manage. Had a really good financial planner. I groomed her for 5 years, got her through her CFP. And then, the pressure, her first year of work was 22 and the markets were, going down and it got to be too much pressure for her. So she actually went back to her old career of being a sonogram tech. So it's just one of those things. A small business, it's harder to replace people. I'm not like a Merrill Lynch where they'll bring in 1,000 people a year, knowing that 2 years from now, 90% of those people will be gone. I can't do that. So I was looking for a way to make sure I'm providing a lot of, service to the clients, getting back to some more hardcore financial planning, and then also. I just wanted to have some more capacity to do things like coffees with Kirk, more education, really just provide more for clients. So obviously offloading the tax business was good for that. I've opened up a lot of capacity that way. But then I also just kind of continued to look for something on the financial planning side. I was like, well, I can continue to hire people and hope that it works out. And if it doesn't, then I have to start from scratch, or I could try to jump into something that, where I've got capacity built in right away. And as it turns out, one of my best friends in the whole world, he and I were in our, what we called swap summer platoon at the Coast Guard Academy. That's sort of like for West Point, that was Peace Barracks. I don't know what they called it in Annapolis or Air Force Academy, but it's basically the boot camp before you actually start the school year. He and I were in the same platoon, so we really got to know each other that way. We were stationed in Hawaii together. We were on different ships, but we were out there together, and we actually lived together. So we had a whole bunch of us get together and rent a place. So really, known him for years, and he's kind of seen the same problems. Like he has it's mostly just a money management firm. He hasn't done any real financial planning. So he's been focused on money management, but always having a trouble getting people in to help him. So he's always kind of on that same treadmill, that hamster wheel that I've been on, and wanting to do a lot more for clients, but just not being able to do that because of capacity. And, and every time both he and I have tried to add more capacity, more people, it always seems to fall apart at some point. It could also be indicative of the younger generation. I've had things where I've had interns get hired, and then the day they're supposed to show up, they don't. And I call or email, and they email me back, go, I decided not to do it. They weren't going to tell me. That's kind of what we're dealing with here. So So he and I are going to join forces, and and we're building up a team here. We've got another certified financial planner who's an Air Force Academy graduate and retired as an 06 in the Air Force. After he got out of the Air Force and then after 9/11 went back in, but he actually did a financial plan. He had his own planning firm and sold that off. And then he just kind of wanted, sort of got bored in retirement. So he's coming back in to work with us. So he brings just a ton of experience and just is really going to help us and add a lot of capacity on the financial planning side. We're hiring another gentleman who is finishing up his CFP work. He was an Army officer for 10 years. His wife is still active duty Coast Guard officer. So Ian is his name, and I think he's still reserves, but he's going to focus on being a financial planner. So we'll have another CFP coming up the ranks. And then on the money management, Cale Smith, who's the owner of the firm I'm merging in with, has hired a new portfolio manager, somebody who worked at the Motley Fool and was their lead analyst. So we're going to add a lot of capacity to this. Now, we had pretty grandiose plans so that by January 1st, we would be fully operational with all of our new offerings, all of our new, the way we're going to charge, everything would be structured, ready to go, and it's just, I don't know if we're going to get to that point. So we've been talking about right now, essentially we'll merge in, nothing will change for you as a client. No fee change whatsoever. Nothing like that. We'll actually, you'll start to see some more planning meetings. You'll start to see some more education, some more videos, some more podcasts, articles, as much as you'd want. Some clients, that's the last thing they'd want to do is spend any time learning about this stuff, but there's some clients that really love it. So we plan to have more of the offerings coming to you. I'm building a kind of subscription service for people that's online, it's video based, it's course based, that you'll have access to when it's live. I don't think I'll have that ready in January, but I'm going to be working on it diligently to get it done as fast as possible. But you'll have access to that. So the first year, I think we're just going to keep things exactly the same. The only thing that'll change will be the name. So we'll go from Picket Fence Financial to Bastion Fiduciaries. Bastion, if you think like the last Bastion, the old the fort with the five, kind of the Pentagon forts that we used to have around the country, that used to be sort of a staple for cities and war fighting. That's kind of what we based it off of, because as you can tell, we're going to have a pretty strong tie to the military, and we're looking to what we're going to try to do as we add people. We're going to look to the military first. We're going to try to get folks who've served and get them in, try to build that maybe a military officer approach. There obviously there's bad people in every facet of life and every place that you work, but we think that typically a military officer or like a senior enlisted military, you kind of trust those folks. You have to. So there's certainly a level of service tied in with the military folks, and definitely kind of an honor code and a mission focus. So we'll look there first. We're not going to have everybody be military, but that's the first place we'll look. And there are a lot of, retired military folks who are looking to get into this field. So we think we're going to have, ample opportunity to bring folks in like that. So just wanted to kind of give you a little update. We're going to have some more updates. I'll have some more formal stuff coming up here, maybe the next Coffee with Kirk, but definitely in November. I'm going to get Cale on. We'll talk about what's going to happen with what it's going to look like. Also, if you want to have a Florida Keys vacation on December 7th, So not Pearl Harbor Day, but we're going to have an event down in the Keys. So Cale does investor conferences for his investors down there. He's actually down in Isla Morada. So he does something. He's got a lot of clients down in the Keys in Southern Florida. So he puts on kind of investor, and he goes through kind of his outlook on companies, things like that. I'm going to present as well in this one. We're going to have, quite a few presentations, and so you'd be welcome to come down to that. You get to meet everybody. You get to hear us. Now, we are going to film these sessions, so you will get this information, even if it's just through kind of a video presentation. But if you wanted to come down and go fishing and relax a little bit down the Keys, I'll definitely be offering invites for that. So that's something just to think about. So yeah, that's kind of what's happening here. I'm going to try to keep you abreast of everything going on. But for you, for the most part, everything's going to stay the same except the name change. I'm still going to be the point person. I'll still be basically kind of, managing the monies. As I mentioned, Cale is just focused on investment management. So we'll dig more into this, but what we're going to take is what we call a core and explore strategy. So I use more exchange traded funds and try to just build up portfolios that focus on the asset class overall, a little bit more passive, a little more well diversified, what we're looking for. Cale is actually a value manager. So he's trying to find stocks that we think or hope will outperform the market, find good quality companies with great cash flows at a discount price. So the core, think of it like 80% core, 20% explore. That's probably how this is going to work. So we'll have some active managers who will focus on the explore part and try to add some extra value to you as an investor, but we'll still have really broad diversification, low cost, indexing, all that good stuff that we always have. But as we add more and more portfolio managers, maybe we start to just build out that core part with some of these managers. I think Cale's vision is eventually, you've got somebody that does international stocks. You might have somebody that's focused on technology stocks. Cale's very big on the energy stocks. So we could start to build these things up over time. So that's basically kind of the vision, and we'll keep throwing this stuff at you so you know. But yeah, if you have questions, please don't hesitate to reach out to me. So basically that's what I've got right now, and we'll be getting more information out to you about the merger and all of that good stuff. And then I'll see you in a couple of weeks for the next Coffee with Kirk. So thank you, everybody.